Most people think they're being smart with their money. They keep it tucked away in a savings account, convinced that by doing nothing they're protecting themselves. They tell themselves, I'm being responsible. I'm playing it safe. But here's the uncomfortable truth. Doing nothing with your cash is quietly, relentlessly destroying your wealth. It feels safe. You can see the balance, touch the numbers, and feel in control. Yet beneath that calm surface, your money is silently losing value year after year. It's a slow-motion disaster that almost no one notices until it's far too late. And the irony is this: the very action that feels prudent is often the most expensive mistake you can make. You might think that investing is risky. You've been warned about volatility, market crashes, and losing everything overnight. But the real risk isn't dramatic. It's quiet. It's invisible. It's the slow erosion of your purchasing power through inflation. And unlike a temporary dip in the stock market, this loss doesn't bounce back. It compounds. Every year you're losing more quietly while the numbers on your bank statement lie to you, whispering that you're fine. Later I'll show you mathematics so simple that anyone can understand it, even a teenager. Numbers that reveal the stark, undeniable reality of what holding cash really costs you over time. No speculation. No theory. Just unavoidable math. And once you see it, you'll understand why millions of careful people are quietly falling behind. This isn't meant to scare you. It's meant to wake you up. Because the moment you recognize the problem, you gain the power to fix it, and to protect yourself from a financial mistake that costs far more than most people ever realize. Imagine a young professional, let's call her Sarah. She's diligent, disciplined, and careful with her money. Every month, she deposits a significant portion of her salary into her savings account. She checks the balance frequently, watches it grow ever so slightly, and feels secure. She's doing everything right, at least according to the conventional wisdom her parents taught her and society reinforces. Cash is king, they say. It's safe. It won't disappear overnight. It won't let her down. Now, imagine what happens over the next decade. Inflation averages 3% per year, a conservative number, by the way, and her savings account pays 0.5%. On paper, her balance appears to grow slowly. She feels comforted by the numbers. She's winning, or so it seems. But in reality, the purchasing power of her money is shrinking steadily. 10 years later, the same balance buys significantly less than it did when she first started saving. She thinks she's playing it safe, but in truth, she's watching her wealth quietly erode. This isn't a rare story. History is full of examples. In post-World War I Germany, ordinary citizens who clung to cash found themselves wiped out by hyperinflation. In Venezuela today, families who believed in safe saving see their hard-earned money vanish in value almost overnight. What feels safe, what looks responsible, is often the most dangerous choice you can make. Why do intelligent, careful people repeatedly make this mistake? It's human nature. Psychologists call it deprival superreaction tendency, the hardwired fear of losing what we already have. We hate the idea of letting go of cash in the present, even when keeping it guarantees long-term loss. We feel more pain imagining a temporary market drop than we do acknowledging the slow erosion of purchasing power. There's also another subtle but powerful tendency at play. We measure what's easy to measure rather than what actually matters. Nominal dollars are concrete. You can see them on a screen or a bank statement. Purchasing power is abstract. It requires thought. It requires discomfort. And humans, by nature, avoid discomfort whenever possible. That's why most people fail to notice the silent decay of their wealth until it has already happened. The problem isn't that Sarah, or anyone like her, is careless. It's that human psychology evolved for survival in a world of scarcity, not for managing money in modern economies. What kept our ancestors alive, protecting every resource against sudden loss, now works against us in a world where money erodes quietly and relentlessly unless we take action. Understanding this psychology is the first step toward breaking the cycle. Recognizing the invisible danger allows you to act rationally, instead of emotionally. Later, I'll show you the specific assets and mental models that protect you from this silent financial drain. But first, you need to see the full scope of the problem. The numbers, the behaviors, and the historical lessons that prove just how costly playing it safe can be. Let's put some numbers on the problem so you can see it clearly. Imagine you have $100,000 sitting in a savings account. Safe, right? Solid. Untouchable. You can see the digits, you feel in control. But let's say inflation runs at a conservative 3% per year, and your savings account yields 0.5%. That means every year your money loses 2.5% of its purchasing power. That's not a hypothetical risk. That's not something that might happen. That's guaranteed mathematics. Over 10 years, that $100,000 doesn't just feel smaller. It actually buys only about $77,000 worth of goods and services in today's terms. Your balance might look healthy, even slightly higher because of nominal interest. But what really matters, what you can actually purchase, has been quietly shrinking. And most people don't notice. They feel safe because the number on their statement is intact, even growing. They are watching the wrong number entirely. Here's a mental model to help you understand why this happens. Invert. Instead of asking, how can I grow my money? Ask, how can I lose it for sure? Suddenly it becomes obvious. Holding cash in a typical savings account in an inflationary environment is choosing the guaranteed path to loss. You are opting for certainty of decay over the possibility of growth. Comfort in the moment, cost in the long term. Another useful concept comes from physics: entropy. Everything naturally moves from order to disorder unless energy is added to the system. Cash has entropy. Its purchasing power decays steadily, relentlessly, unless you do something to counteract it. Ignoring this reality is like standing in a river, thinking you're stationary, while the current slowly sweeps you downstream. You're moving, just not in the direction you want. Now let's contrast this with the typical fear people have about stocks or investments: volatility. A diversified stock portfolio might drop 15% in a difficult year. That's volatile, painful, but temporary. Historically, the markets always recover. Cash, on the other hand, is far less dramatic. It doesn't spike or crash, but it is guaranteed to lose purchasing power year after year. That loss is permanent. You never recover it unless you take action. The difference is subtle, but it's crucial. People mistake volatility for risk. They fear temporary drops and overvalue the visible safety of cash. What they ignore is the slow, invisible, mathematically certain destruction of wealth. And that misperception is extraordinarily expensive. The solution begins with awareness. Understand that risk isn't about numbers fluctuating on a screen. Risk is permanent loss. Understand that comfort and visibility are not safety. Understand that doing nothing is not safe, it's silently costly. And understand that you can use simple mental models, like inversion and entropy, to see the real problem clearly and avoid falling into the trap that ensnares millions every decade. Once you grasp these hidden dangers, the next step is to understand how to act rationally, how to allocate capital in ways that protect purchasing power, harness compounding, and reduce exposure to the quiet, relentless decay that cash guarantees. That's where the mental models meet actionable strategies, and where most people, unfortunately, never venture. Once you understand the hidden dangers of safe choices, the question becomes, how do you avoid them? How do you act rationally in a world that constantly tempts you with comfort over logic? The answer lies in a few timeless principles that govern smart decision-making. These aren't tricks or hacks. They're frameworks that anyone can follow, if you're willing to think clearly and act deliberately. The first principle is circle of competence. This is simple, but it's ignored constantly. You must know what you truly understand, and, just as importantly, what you don't. If you can analyze businesses, understand how they generate cash, and assess pricing power, then owning shares in those businesses may be within your circle of competence. If you understand real estate, know the local market, tenant behavior, and property economics, then productive real estate may be your strength. But if you step outside this circle, buying businesses you don't understand or real estate in unfamiliar markets, you're taking unnecessary risks. Most mistakes aren't random. They come from acting outside your circle of competence. The antidote is brutally honest self-assessment. Know your strengths, know your limits, and stay within them. The second principle is emotional awareness. Humans are not rational calculators. We are wired to feel, and feelings often sabotage good decisions. Psychologists describe this as deprival superreaction tendency. We hate losing what we already have far more than we enjoy gaining something new. This makes cash feel safe while the mathematics scream otherwise. Add to that social proof. We follow what others do, assuming the crowd knows better, and availability bias. We overweight vivid losses in memory over slow, invisible erosion, and you have a perfect recipe for poor decisions. Recognizing these biases is crucial. The goal isn't to eliminate them, they are human, but to build systems that protect you from acting on them. The third principle is understanding compound interest and opportunity cost. Most people know the story about compounding in theory, but they don't appreciate its full power, especially in reverse. If you leave cash earning near zero interest while inflation steadily erodes its value, you are experiencing reverse compounding. Losses accumulate quietly year after year. Conversely, investing in productive assets allows compounding to work in your favor. The difference isn't subtle. Over decades, it determines whether you retire comfortably or struggle financially. Opportunity cost is the flip side. Every dollar you keep in cash is a dollar not working for you in productive assets. It's not just a missed return, it's a missed advantage over the years that multiplies exponentially. Consider $100,000 sitting in cash versus invested in an asset generating 7% real returns. Over 30 years, the difference isn't a few $1,000s. It's hundreds of thousands, literally the difference between financial mediocrity and security. These principles, circle of competence, emotional awareness, and compound interest with opportunity cost, interact to create a framework for rational action. They help you separate noise from reality, emotion from logic, and appearances from truth. Following them requires patience and discipline. You won't see dramatic results overnight, but you will avoid predictable mistakes that destroy wealth silently over time. Rational investing isn't exciting. It doesn't provide the adrenaline rush of a market rally or the glamour of a hot tip. But boring, consistent, rational action compounds results far more reliably than cleverness or emotion ever could. Avoiding stupidity consistently over decades is far more powerful than chasing brilliance. And it is accessible to anyone who is willing to think systematically, know their limits, and act deliberately. With these principles in mind, you can now understand why some assets truly preserve and grow purchasing power while others, cash above all, slowly destroy it. The next step is to examine these 5 categories of real assets that outperform cash, the mental models behind them, and how you can use them to protect yourself from the silent erosion we've discussed. Now that we understand the principles, let's talk about the assets that actually protect and grow your wealth. Not all assets are created equal. Cash sits still and decays. Stocks fluctuate but can grow. Real estate can produce income. Skills compound over a career. Bonds and hard assets have their place if chosen carefully. The common thread among all these is that they do something real. They generate value, not just hope. Asset number 1. Ownership in productive businesses. Most people call these stocks, but that's just a label. The reality is you're buying partial ownership in actual companies. The critical mental model here is pricing power. A well-managed business with genuine pricing power can adjust for inflation automatically. Costs rise? Prices rise proportionally. Profits grow. Your ownership grows. Consider a company like Coca-Cola. When production costs increase, Coca-Cola doesn't passively lose value. It raises prices, maintains margins, and continues generating earnings. Contrast that with cash, which has no pricing power. It simply loses purchasing power steadily. Caveat: this only works if you stay within your circle of competence. Buying random stocks, trading frantically, or chasing hot trends turns a productive asset into a speculative gamble. Discipline and understanding are essential. Asset number 2. Income-generating real estate. Not all property is equal. The key is productivity. Does the property generate real, ongoing income? Rental properties producing steady cash flow are effectively small businesses. And in an inflationary environment, rents typically rise while fixed mortgage payments become cheaper in real terms. Here's the mental model. Think like a business owner. If the property stopped appreciating tomorrow, would the income alone justify ownership? If the answer is yes, it's a productive asset. If not, it's speculation. Caveat: real estate requires judgment, maintenance, and management. Buying without knowledge can destroy wealth rather than grow it. Asset number 3. Your own skills and earning power. This is often the most overlooked asset. Investing in your skills, through education, training, or deliberate practice, compounds over your lifetime. Unlike stocks or real estate, these skills cannot be taken away by a market crash. Mental model: present value of future earnings. Improving your skills even modestly can multiply your earning potential far beyond what most financial assets could deliver. But it works only if the skills are relevant, in demand, and difficult to replicate. Obscure or unmarketable skills won't move the needle. Asset number 4. High-quality bonds. In specific situations, bonds are promises to pay a fixed amount at a future date. The question is, what will that money be worth when you receive it? High-quality short-term bonds from creditworthy issuers can provide liquidity and optionality. They're not wealth-building, they're tools for stability and opportunity. Mental model: yield versus inflation. If a bond doesn't meaningfully beat expected inflation, it's effectively another form of cash, subject to purchasing power decay. Caveat: long-term bonds or low-quality bonds can be dangerous, locking capital while real value erodes. Asset number 5. Useful hard assets that produce real value. Not all tangible assets are equal. Gold, for example, sits passively, generates nothing, and cannot adapt. The key is productivity. Farmland growing crops, machinery generating income, or equipment enabling a business to operate are all hard assets that create real economic value. Mental model: function over hope. The asset must produce something useful, regardless of market perception. Speculating on collectibles or precious metals rarely protects wealth as effectively as truly productive hard assets. Caveat: ensure the asset's utility is real and ongoing, not dependent on someone else's future willingness to pay. The common theme across all five is simple: productivity, adaptability, and real value creation. Cash does none of these. It sits, motionless, decaying quietly over time. Productive businesses, income-generating real estate, high-value skills, select bonds, and useful hard assets grow and protect real wealth because they act. They do something. They resist the slow, invisible decay that cash guarantees. By allocating thoughtfully among these categories, according to your circle of competence and time horizon, you can dramatically improve your financial outcomes while avoiding the invisible trap of guaranteed loss. Even after understanding the hidden dangers of cash and the power of productive assets, most people still make costly mistakes. And it's not because they're stupid. Far from it. In fact, some of the most intelligent, successful people fall into the same traps over and over. The reason is human psychology. The first trap is social proof. We tend to follow what others do, assuming that the crowd knows best. If everyone keeps money in savings accounts, it feels safe to do the same. Parents, colleagues, friends, they all reinforce this behavior. It feels like the responsible thing to do. But social proof is neutral. It doesn't guarantee correctness. In fact, in financial matters, it often guarantees mediocrity. History is full of examples where the socially normal choice was catastrophically wrong. People who clung to cash in hyperinflationary Germany or Venezuela were following the safe path everyone else took, and lost everything. The second trap is availability bias. Humans overweight dramatic, vivid events over slow, invisible ones. A market crash makes headlines. You see friends panic and lose money overnight. That sticks in your mind. Meanwhile, the slow erosion of purchasing power through inflation is boring, abstract, almost invisible. Yet the latter is far more damaging over time. People fear the dramatic loss they can see while ignoring the quiet, inevitable loss that actually matters. Finally, there is our innate fear of loss, which behavioral psychologists call deprival superreaction tendency. We hate giving up what we already have far more than we enjoy gaining new wealth. It's why cash feels safe, and why we hesitate to put money to work, even when the math proves otherwise. We choose the guaranteed slow loss of purchasing power over the probabilistic, historically proven growth of productive assets. All because of a feeling. These psychological tendencies are predictable, universal, and powerful. They operate quietly, without conscious awareness, shaping our decisions more than logic or knowledge ever could. And until you recognize them, they will continue to sabotage your financial future. The solution isn't to eliminate these instincts. They're part of being human. The solution is awareness and systems. Name the bias when you notice it. Build decision-making processes that protect you from emotion. Focus on long-term outcomes, not short-term comfort. Ask yourself, am I choosing this because it's rational or because it feels safe? Most of the time, the uncomfortable truth is that the choices that feel safe are the ones that are quietly, invisibly, and predictably destroying wealth. Understanding these psychological traps is just as important as understanding math or investing principles. In fact, for most people, psychology is the bigger challenge. You can master compound interest, diversification, and asset allocation. But if your instincts and biases control your behavior, the smartest strategies will fail. Recognizing this is the first step toward doing what most people cannot: consistently making rational long-term decisions that preserve and grow real wealth. Understanding the principles and psychology is important, but knowledge alone isn't enough. You need a practical framework to guide decisions, a way to translate insight into action. This isn't about guessing or following someone else blindly, it's about asking the right questions and thinking systematically. Question 1. What is my circle of competence? Start by identifying what you truly understand. Can you evaluate businesses? Assess real estate markets? Read financial statements? Invest in areas where your knowledge is strong. Step outside that circle and you risk turning opportunity into disaster. Discipline isn't boring, it's profitable. Question 2. What is my real risk? Most people focus on volatility. Will the stock market drop 20% this year? But the real question is, Will I have enough purchasing power to live the life I want? Focus on permanent loss, not temporary discomfort. Identify which choices protect your long-term security, and which feel safe but erode it quietly. Question 3. What is my honest time horizon? If you need money in 6 months, cash is fine. But if your horizon is 10, 20, or 30 years, voluntarily choosing assets guaranteed to lose purchasing power is irrational. Align investments with your timeline. The wrong horizon creates predictable losses. Question 4. What are the second-order consequences? Think beyond immediate effects. Holding too much cash doesn't just reduce returns, it can mean delayed retirement, fewer options, and decades of opportunity lost. Consider the long-term ripple effects of every choice. Question 5. What does inversion tell me? Flip the question, what happens if I do nothing or stick only with cash for the next 20 years? If the likely outcome is unacceptable, what adjustments can I make today to change it? Inversion reveals the invisible consequences that comfort and emotion often hide. The power of these questions is in writing down answers, not just thinking them. The clarity that emerges is astonishing. Most people never do this. They react emotionally day to day, hoping things work out. You can break that pattern. By systematically addressing these 5 questions, you make rational decisions, protect against predictable mistakes, and gain control over outcomes that most people leave to chance. Let's be clear, cash does have a role. You need liquidity for genuine emergencies. Your car could break down, your roof could leak, or unexpected medical bills could appear. For these situations, having 3 to 6 months of actual expenses in liquid cash or near cash equivalents is rational and necessary. This is your sleep well at night money, completely safe, completely accessible, and untouched except for real emergencies. But most people take this principle to an extreme. They hold years of expenses in savings accounts, convinced they're being responsible. This isn't prudence, it's financial malpractice. Excess cash loses purchasing power year after year. Every extra dollar sitting idle is a dollar guaranteed to shrink in real terms while your life goals, retirement, or investment opportunities are left unfunded. Think about it this way. If you spend $50,000 annually, your emergency fund should be roughly $15,000 to $30,000, not $300,000. The rest should be working productively in businesses, real estate, your skills, or other assets that grow purchasing power. The difference between holding too much cash and investing rationally compounds over decades into tens or hundreds of thousands of dollars, or more. The point isn't to eliminate cash, it's to use it intelligently. Keep enough to sleep at night. Keep the rest working for you. That balance separates rational preparation from costly inaction. True financial responsibility isn't about avoiding all risk in the short term. It's about protecting yourself from the long-term, invisible risks that destroy wealth quietly while feeling safe in the moment. Here's an uncomfortable truth. Much of the financial industry doesn't exist to make you wealthy. It exists to make money, from fees, commissions, products, and your fear. Every time you trade, panic, or chase a hot tip, someone profits. Your incentives are rarely aligned with theirs. This is why simple, rational decisions often outperform expert advice. Buying productive businesses, holding them for decades, investing in your skills, and keeping cash for genuine emergencies, these actions require no glamour, no complicated strategies, no expensive guidance. Yet they consistently beat frantic activity, overcomplicated plans, and expert predictions over the long term. Complexity sells. It makes advisors feel necessary and clients feel helpless. But complexity is not intelligence, it is a distraction. Rationality, patience, and clarity are far more powerful than cleverness or intricate products. The difference is simple. The rational investor avoids predictable mistakes and lets time and compounding do the work. Understand this. You don't need insider information, extraordinary intelligence, or fancy tools to succeed. What you need is awareness, discipline, and honesty with yourself. Recognize the incentives around you. Question whether advice is designed for your benefit or someone else's profit. Then act deliberately, based on timeless principles and proven mental models. Ultimately, the most powerful financial tool you have isn't a product or a market insight. It's your ability to think clearly and act rationally. History proves this repeatedly. While others chase trends, panic, and pay fees, the rational, patient approach quietly compounds real wealth. Let's bring it all together. The financial landscape is filled with noise, fear, and temptation to chase comfort over logic. But the path to real wealth is simple, if not always easy. Be rational, be patient, and avoid predictable mistakes. That's it. Nothing more complicated, nothing secret. Remember the mental models that guide this approach. Compound interest works both ways. Use it to grow assets or watch reverse compounding erode cash. Opportunity cost reminds you that every dollar sitting idle is a dollar lost to time and inflation. Inversion forces you to ask, what am I guaranteed to lose if I do nothing? Finally, know your circle of competence. Invest only in what you truly understand and can manage. These tools give clarity in a world full of confusion. Now the actionable steps are clear. First, allocate capital to productive assets. Businesses with pricing power, income-generating real estate, high-value skills, carefully selected bonds, and useful hard assets. Second, invest in yourself. Expand your knowledge, sharpen skills, and increase earning potential. Third, maintain patience and consistency. Wealth is built over decades, not days. Resist the temptation to chase short-term thrills or the fear of temporary losses. This isn't theory. History proves it works. People who act rationally, avoid emotional mistakes, and think systematically consistently outperform those who react to headlines, follow the crowd, or hoard cash for comfort. The mathematics are simple, the psychology is predictable, and the framework is accessible to anyone willing to apply it. You don't need genius-level intelligence, insider information, or luck. You need clarity, discipline, and patience. Take action today. Apply these models, focus on real assets, and let time and rationality do their work. The choices you make now will determine whether you watch your wealth quietly decay or steadily grow. The difference is yours to decide, and the time to decide is now.